This is Andy Chambers. Thank you for joining me for today's update. We're going to start by taking a look at the Dow. The Dow has been in a strong bull trend for almost 5 years. It has more than doubled in value since the 2009 low. Despite the long-term uptrend, there are always corrections. Right now, the daily chart shows that the bears have the momentum. On January 31st, the Dow closed below 15,703.79. That close below the previous daily swing low broke the daily pattern of higher highs and higher lows that had been in place since October. Breaking the pattern of higher highs and higher lows suggests a further decline. Based on this break of support, on a daily basis, we would be looking to sell rallies. The Friday, January 31st close below 15,703.79 also broke the pattern of higher highs and higher lows on the weekly chart. Breaking the weekly pattern of higher highs and higher lows also suggests that the Dow is likely to decline further before it resumes the bull trend. Here's a weekly chart of the Dow with Fibonacci retracement lines drawn. For chart analysts, Fibonacci retracement lines are price levels where the market could find support after a pullback in an uptrend or resistance after a rally in a downtrend. In this case, we're looking for support in an uptrend. By January 31st, the Dow had already retraced 50% of the move from the October low to the December high. The next Fibonacci retracement levels are marked at 61.8 and 76.4. A weekly close below the October low of 14,719.43 could result in a much larger decline. On the daily chart, the January decline in the Dow looked sharp and severe enough to cause a great deal of concern about the long-term bull trend. On a monthly chart, the pullback looks much more benign, and the January bar hardly hints that it could mark a major top. Longer term, we expect the pullback to set up a new long-term buying opportunity. The next long-term upside targets are 16,500, 17,000, and 17,500. Next, we'll take a look at XLU. XLU is the symbol for the S&P Select Utilities Spider Fund. XLU appears to be forming a symmetrical triangle. A symmetrical triangle is usually a trend continuation pattern. The monthly chart shows that the overall trend for XLU has been up since 2009. So, when the consolidation is over, it is likely to yield to a further advance. Ideally, a symmetrical triangle will have 3 lower highs and 3 higher lows, just like the XLU-Weekly chart. The January 31st upside breakout of the symmetrical triangle suggests a further advance. We can estimate an upside target for the breakout by adding the width of the first leg down to the breakout point, and the first leg down is the widest leg down. The width of the first leg down is 564 points, or 5.64. The breakout point is about 39 even. That gives us an upside target of about 44.64. A weekly close below 37.11 would void the current bullish setup. The monthly chart for McDonald's shows a great example of a symmetrical triangle back in 2009. McDonald's hit the target of 79, pulled back, and then took off again. As we said, the target was 79, but it ultimately hit 100. Next, we'll take a look at UNG. UNG is the symbol for the United States Natural Gas Fund. UNG was a high flyer that's been grounded for the last few years. With all the great news I hear about natural gas, I have to believe it's going to turn back up again sometime. The initial move up for UNG could be starting right now. On January 29th, UNG was over 27. Then it pulled back almost $4 in 2 days. A close over the January high of 27.05 could ultimately result in a move toward 40. A close below the January low of 1947 would put the immediate bullish outlook on hold. We still think it will take off sometime. Well, that's the last chart for today. Thank you for your time and attention. Good luck and good trading.